Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday, March 15th, the Ides of March, and birth date of our firstborn. We wrote a report this week titled 2Q21 Outlook, Room to Run. It was intended to be just that, an outlook for the second quarter of this year. We began with a broad discussion about how we think that the reopening disruption related trade that we've been expecting is largely over. As we mentioned in our prior call, that our framework for thinking about corrections early in the business cycle, when the economic impulse is particularly strong, is that you really do need some sort of policy contraction in order to trigger a correction as big as 10%. Back to the 2009 global financial crisis business cycle, even with how tepid that recovery was, 4% nominal GDP through the cycle, what originally looked reasonably strong deteriorated into very sluggish growth because of the debt overhang and a lot of the policy reactions to the global financial crisis. Even then, all of the corrections came as a consequence of either the Fed withdrawing policy or fiscal policies tightening. So until we get to that point where the Fed is talking about tapering, and it becomes clear that the Biden tax hikes are going to be used to pay for the Build Back Better plan, we don't think a 10% correction is particularly likely. So when we had the 6% correction, we suggested adding risk, and obviously that entire sell-off was retraced last week and we went to new highs. And we do think as we move into the second quarter, we'll really be at maximum velocity for the liquidity injections into the economy. So specifically, that means the Treasury General Account of which currently sits at $1.5 trillion, is going to get drawn down. It's supposed to, by law, go down to $120 billion by the beginning of August. A lot of the way that liquidity will get into the system is that stimulus checks that are going out. Bank deposits will surge and there'll be abundant liquidity. The Fed will continue to buy $120 billion worth of securities a month, 80 billion of treasuries, 40 billion of mortgage-backed securities. There'll be some additional liquidity created as the global manufacturing and trade recovery hits its stride, resulting in the creation of additional dollars. U.S. current account deficit will surge. That will eventually become something of a political problem for the world, as we wrote last week in our Bretton Woods 2 note. But in the meantime, that will create abundant liquidity, some of which at least will get recycled into the U.S. Treasury market or the front end of the U.S. Treasury market and create additional liquidity. So the second quarter, we are going to have all those things clicking on all cylinders. And from a macroeconomic perspective, we've talked about our three tailwinds for 2021. The first one being a global trade and manufacturing recovery. I just discussed that. Supply chain should start to clear, and that should be at really its maximum point of upside in the second quarter, though the rate of change indicators like purchasing manager survey should start to go down a bit. Still, the level of economic activity will be quite strong. We think it'll become increasingly clear that we're getting a strong recovery in capital spending as we get into the second quarter, which certainly holds out good longer-term news for U.S. markets in particular. It's a driver of productivity, a driver of hiring. Profit margins benefit from capital spending over time. Again, this will be increasingly evident as we get into the second quarter. And then, of course, that third tailwind is the price effect of both of those things. It's reflation, and that will be at its maximum point of velocity as we get into the second quarter. Nevertheless, there are continued risks. It's early for those risks to really manifest themselves and cause a 10% correction, as we said. First of all, there is the tax hikes. Now, we don't think that bill is likely to be done before the third or fourth quarter. How that gets discounted into the market, stimulus-related or fiscal policy-related actions, is a little bit less clear than Fed related actions. All they have to do is talk about tapering, and we'll have something of a policy normalization shock. We think that couldn't come any earlier than June, and more likely gets pushed a little later in the summer. But this tax hike issue will start to bubble up. For the record, in the CNBC Fed survey this week, we were asked about the effect of the Biden rescue plan, known as ARP, American Rescue Plan, and we penciled in a smaller than most would multiplier, a Keynesian multiplier on the spending aspect of this. So what it means for GDP. Half the money's being spent this year. We put a 0.3 multiplier on that. Most Keynesian economists, we suspect, would be putting something more like 0.6 or so. We also thought that it would increase inflation, not just this year, but next, because again, a lot of the spending does come in out years. We didn't think it would do much for growth next year. The way the money is being spent is not a real driver of capital spending, the things that really matter for investors. And we thought it would raise the unemployment rate, not lower it. And we've talked a lot about the disincentives that get created by all of these various support plans and the government's seemingly inability to withdraw these plans on time. So extending the extra $300 per week, where CBO scores more than half of the people are actually making more money not working than they would be if they were working. That sort of thing will slow the recovery in the labor market. So while it may be good policy, we're not making any normative statement about that. We do think it'll slow the recovery in the labor market. We've seen that in the latest, even last week's jobless claims numbers. We didn't write about that this week, but surely continuing claims are a lot higher than they were at the beginning of the year, and the sharp downtrend that was in place for most of the back half of 2020 has been interrupted as a consequence of all these support programs. So as we move on to think about the second quarter, we did a deep dive in our report this week on our sector allocation views. Should definitely be a subscriber to go through all that. And we had a performance table in there showing every business cycle since S&P introduced the sectors back in 1989, what did well in the first 3 months of a recovery, 6 months, and year of a recovery. We're just about a year out now, as everyone knows. And there's a number of sectors that always perform well early in the business cycle. Small caps outperform, consumer discretionary outperforms, materials outperform, financials outperform, and tech has outperformed every cycle except for, strangely, the 90s when tech went into their absolute boom. But these are the early stage business cycle sectors. We were long them from the lows and continue to recommend most of them, although we did downgrade consumer discretionary in the summer, and we downgraded tech at the very end of the summer. We would not be underweight tech at this point because of the cyclical aspects of it and the fact that we're still fairly early in the business cycle. We prefer to have our underweights in the defensive sectors, and that's where we've been throughout this entire recovery. We're transitioning now, we think, or beginning to transition as the reopening process completes itself, from playing the business cycle and really leveraging your sector bets based on the business cycle to more secular trends through this cycle. So that those trends that we think are likely to persist through this cycle, one is reflation. We don't believe it's transitory. We believe it's going to be endemic of this entire cycle. The next is that the benefits of the cloud and digitization start to migrate from the producers of that technology to the consumers of that technology. So healthcare companies, industrial sector companies, consumer companies have already been benefiting from it for some time. And so that process will be another secular trend. A third secular trend is we do think this should be a very strong capital spending cycle, although there is some risk that the Biden administration gets a little carried away with fairness as it pertains to corporate tax rates and degrades our competitiveness. Remember, most studies on this, including from the CBO, showed that the US had pretty much the least competitive corporate tax code in the developed world prior to the Tax Cuts and Jobs Act. We're now in the middle of the pack. The Biden tax plan would take us back to the bottom of the barrel. So that would not be a plus for our capital spending through the cycle theme. But other trends like deglobalization and just the market rendering it no longer economically viable to stretch your supply chains all over the world. We think those are much stronger trends that would argue for a very strong capital investment cycle as it pertains even to physical plant and equipment. And then the final trend, secular trend, is we think the price of oil is going to be more stable this cycle. Shale technology has fundamentally changed the elasticity of supply. So if you think about those four trends, a couple of sectors are obvious beneficiaries of a couple of them, materials and energy. The financial sector should be a beneficiary of reflation. We're a little bit concerned about innovation and whether they really do get on board with this technology innovation adoption. The post-crisis culture in the global financial sector makes them somewhat vulnerable to fintech overtaking them. We'll see. We are still long our financials, but somewhat concerned about that. But the sector that dovetails with a number of these trends could arguably benefit from all of them is the industrial sector. So that remains basically our strongest pick. So to summarize, for the second quarter, we are getting maximum liquidity injections from the stimulus, from the Treasury drawing down their general account at the Fed, from Fed asset purchases, and the macro tailwinds that we've talked about will be at their sort of maximum point of velocity in the second quarter as well. That's a global trade and manufacturing recovery, a capital spending recovery, and that reflation theme. With all those things going for the markets, it's hard to see a significant setback until and unless we get deep in on the Biden tax hikes and the Fed starts talking about tapering. So that's it for me this week. We'd love you to become a subscriber. There's lots of material in the notes, tables and charts for you to dig in on, and very specific recommendations. This is Barry Knapp, Ironsides Macroeconomics. Have a good week, everyone.